The first quarter earnings cycle of 2026 has divided the technology sector based on how efficiently companies turn massive AI spending into revenue. While Alphabet and Apple saw their stock prices surge, Meta and Microsoft faced steep penalties as investors scrutinized their quarterly reports. Wall Street is prioritizing companies that can prove immediate profitability from their AI infrastructure right now. This chart plots Q1 capex against market reaction for the four hyperscalers, projecting $650 billion in spending. Alphabet entered the positive quadrant, with Google Cloud hitting 18% revenue share. Meta and Microsoft fell into the negative quadrant, raising spending without sufficient immediate AI-driven growth. Apple took a different approach. The company saw its stock surge by accelerating growth in high-margin services while sidestepping the massive capital expenditure race. These results suggest that heavy capital investment has become a market liability for any company that cannot deliver blowout earnings. This shift is widening the semiconductor rally beyond AI specialists into companies supporting broader infrastructure. This dual bar chart shows how Texas Instruments is serving as a macroeconomic indicator. Their data center revenue grew 90% year-over-year, while industrial demand rose 30%. Qualcomm is also diversifying its revenue, moving into custom silicon for data centers and maintaining a $5 billion run rate in its automotive segment. These hardware metrics indicate that tech infrastructure demand is becoming structurally resilient across multiple industries, signaling an end to the 2025 inventory slump. Three specific risk factors will determine tech valuations during the next earnings cycle. First, software providers must demonstrate enterprise adoption, such as growth in Microsoft Copilot seats, to justify the costs of the hardware. Second is memflation. A 125% increase in DRAM prices is expected to squeeze the profit margins of hardware manufacturers. Third is the architecture war. Investors are tracking whether CPUs can capture inference workloads as tasks move toward more complex orchestration. Future valuations will depend on whether companies can maintain their margins against these rising hardware and memory costs. The Magnificent Seven has split into two groups, the hyper-investors and the disciplined growers. For the hyper-investors, stock performance is now tied to the long-term return on the $500 billion they have committed to infrastructure. Success in the coming quarters will be measured strictly by capital efficiency and the ability to protect profit margins.